A bond promises to pay that $1,000 at maturity. So why would a rational investor pay $900 for it, or $1,100? The answer depends on far more than the number printed on the contract. Timing, interest rates, credit risk, liquidity, and embedded options all matter. In this lecture, we decode how a bond's promised cash flows become its market price. This is one of the most important topics in finance, because bonds connect investors, companies, governments, and interest rates. When a company wants to borrow money, it may issue bonds. When a government wants to finance public spending, it may issue bonds. When investors want income, diversification, or exposure to interest rates and credit risk, they often look at bonds. A bond is a debt security. The issuer receives money today and promises to make payments in the future. For a plain vanilla bond, these payments usually include interest payments during the life of the bond and repayment of principal at maturity. The phrase fixed income can sometimes be misleading. Not every fixed income security has fixed payments. Some have floating rates, inflation adjustments, embedded options, or credit risk. The common idea is that we value the security by analyzing promised or expected cash flows and discounting them at a required return. So in this lecture, our goal is simple: understand what bonds are, how they work, why bond markets matter, and how finance professionals think about bond value. By the end, you should be able to look at a bond and ask the right questions. Who is the issuer? What are the promised cash flows? What risks affect those cash flows? And what return should investors require? Let's begin with the basic language of bonds. The issuer is the borrower. It may be a national government, a corporation, a municipality, a government-related entity, or an international organization. The investor who buys the bond becomes a lender to that issuer. Par value is the principal amount the issuer promises to repay at maturity. Think of it as the amount on which the bond contract is built. The market price may be above or below this amount, but the par value remains an important reference point. The coupon rate is the stated interest rate used to determine the bond's coupon payment. For a fixed-rate bond, the coupon rate is set by contract. This means the promised coupon doesn't automatically change just because market interest rates move. Maturity is the date when the issuer repays the principal. Maturity matters because time matters. The longer the bond's life, the longer investors are exposed to changes in interest rates, inflation expectations, and issuer risk. Yield is a return measure that connects the bond's price with its promised cash flows. A very important yield measure is yield to maturity, which summarizes the return implied by the current price and the promised payments. Finally, the indenture is the legal agreement behind the bond. It specifies the terms, payment dates, maturity, covenants, collateral, call provisions, and other important features. Before valuing any bond, we must understand its contract. Valuation begins with cash flows, and the contract tells us what those cash flows are supposed to be. Now let's look at common bond features. A fixed-rate bond pays coupons based on a stated coupon rate. This is the classic bond structure most students learned first. The coupon is set by contract, so the bond's price adjusts when market-required returns change. A floating-rate bond is different. Its coupon resets according to a reference rate or index, subject to the bond's contract. This can reduce some interest rate sensitivity, but it introduces other details that must be understood. A zero-coupon bond pays no periodic coupon. Instead, it is issued or traded at a discount and pays principal at maturity. The investor's return comes from the difference between the purchase price and the maturity value. Some bonds are secured, meaning they are backed by specific collateral. Others are unsecured, meaning investors rely on the issuer's general creditworthiness. Seniority also matters. Senior bonds have priority over subordinated bonds if the issuer cannot meet its obligations. Some bonds include embedded options. A callable bond gives the issuer the right to retire the bond early under specified conditions. A puttable bond gives the investor the right to sell it back to the issuer under specified conditions. A convertible bond gives the investor the right to convert the bond into another security, usually common stock. Covenants are also important. They are contractual rules designed to protect bondholders or define issuer behavior. Each feature affects cash flows, risk, and value. That is why bond analysis isn't just about applying a formula. It is about understanding the economic meaning of the contract. Let's now think about bond cash flows and bond markets. A plain vanilla coupon bond has two basic cash flow components: coupon payments and principal repayment. Coupon payments are interest payments made at regular intervals. Principal repayment is the return of par value at maturity. This structure gives coupon bonds an important pattern. Part of the value comes from the stream of coupon payments. Another part comes from the repayment of principal at maturity. When we value a bond, we value both parts. Zero coupon bonds have a simpler cash flow structure. There are no interim coupon payments. The investor pays less than par value today and receives par value at maturity. Even though the cash flow pattern is simple, the same present value logic applies. Now, where do bonds trade? In the primary market, issuers sell new bonds to raise capital. This is where borrowing begins. In the secondary market, investors trade existing bonds with other investors or dealers. This is where prices continue to adjust as interest rates, credit risk, liquidity, and market conditions change. Many bonds trade through dealer markets rather than centralized exchanges. That means liquidity and price transparency can vary across bond issues. Large, frequently traded government securities are usually more liquid and smaller or more specialized bonds. Bond market participants include governments, corporations, municipalities, institutional investors, mutual funds, exchange-traded funds, insurance companies, pension funds, banks, dealers, and individual investors. So bond markets aren't a side topic in finance. They are a major channel through which capital moves across the economy. The bond market contains many categories of securities. A useful starting point is to think about Treasury bonds, corporate bonds, municipal bonds, and international bonds. Treasury securities are issued by national governments. In the United States, Treasury securities are often treated as default risk-free for dollar-denominated nominal payments. That doesn't mean their prices never change. Treasury prices still move when interest rates change. But Treasury yields are important because they are widely used as benchmark yields. Corporate bonds are issued by companies. A corporate bond allows a firm to borrow from investors rather than borrowing from a bank or issuing common stock. Corporate bonds can differ widely in credit quality, maturity, coupon structure, collateral, seniority, covenants, call features, and liquidity. Municipal bonds are issued by state and local governments or related public entities. They may finance schools, transportation systems, utilities, hospitals, public buildings, or other public purpose projects. Their valuation often requires attention to credit quality, revenue sources, liquidity, and tax treatment. International bonds are issued, sold, or denominated across national markets. They allow issuers to access investors outside their home market and allow investors to gain exposure to foreign interest rates, currencies, issuers, and credit conditions. These categories are useful, but they are only the beginning. Two bonds in the same category can have very different risks. A careful analyst always goes beyond the label and studies the actual cash flows, contract features, issuer quality, tax treatment, currency exposure, and liquidity. Let's spend a little more time on Treasury and corporate bonds. Treasury securities play a special role because their yields are commonly used as benchmarks. Investors often compare the yield on another bond to the yield on a Treasury security with similar maturity. The difference is called a yield spread. A yield spread isn't random. It reflects risks and features that aren't present or not present in the same way in the Treasury benchmark. These may include credit risk, liquidity risk, tax treatment, and embedded options. Corporate bonds are especially interesting because they connect valuation with business risk. When investors buy a corporate bond, they are lending to a company. The key question isn't only what did the company promise? The key question is also how reliable are those promises? Corporate bond investors worry about default, downgrades, financial distress, refinancing risk, industry conditions, leverage, and liquidity. If investors see more risk, they demand a higher return. That higher required return lowers the value of promised future payments. For managers, corporate bond yields are market signals. A higher yield means a higher cost of debt capital. It may reflect general interest rates, but it may also reflect firm-specific concerns. A company with weaker credit quality, more leverage, or less investor protection will usually face a more expensive borrowing environment. This is why bond markets discipline issuers. The market doesn't simply accept promises. It prices the risk behind those promises. Now, let's look at municipal and international bonds. Municipal bonds are connected to public finance. They may support roads, schools, utilities, hospitals, public buildings, or other projects that serve communities. But municipal bonds aren't all the same. A general obligation bond is supported by the issuer's broad taxing or fiscal capacity. A revenue bond is supported by revenue from a specific project or source. This distinction matters because the source of repayment affects credit analysis. Municipal bonds may also receive favorable tax treatment, depending on the bond, the investor, and applicable tax law. Because taxes affect after-tax return, investors must be careful when comparing municipal yields with taxable bond yields. A lower quoted yield may still be attractive if the tax treatment is favorable to the investor. International bonds add another layer of complexity. A foreign bond is sold by a foreign issuer in a domestic market and is usually denominated in that domestic market's currency. A Eurobond is issued outside the country of the currency in which the bond is denominated. With international bonds, investors must consider currency risk. If the cash flows are in a foreign currency, exchange rate movements can affect the investor's realized return. Investors may also face country risk, legal differences, withholding taxes, settlement conventions, and liquidity differences. The valuation foundation is still present value, but the analyst must identify the relevant cash flows, the currency of those cash flows, the proper required return, and the risks that affect timing and payment. Now we move to the heart of bond valuation. The value of a bond comes from its promised or expected cash flows. To value those cash flows, we discount them at a required return that reflects time value and risk. A coupon bond can be understood as a combination of coupon payments and principal repayment. The coupon payments are like a stream of regular cash flows. The principal repayment is a lump sum at maturity. Bond valuation puts these pieces together in present value terms. This interpretation is powerful because it shows why the coupon rate alone doesn't determine the bond's price. The bond's value depends on the coupon amount, the maturity value, the timing of payments, and the return investors require. Timing must be handled carefully. If the bond pays annually, the cash flows and discount rate must be treated on an annual basis. If the bond pays semi-annually, the cash flows and discount rate must match that payment period. If the timing doesn't match, the valuation becomes inconsistent. This is one of the most common mistakes students make. They know the right idea, but they mix timing conventions. Finance is very sensitive to timing. A cash flow received sooner isn't the same as a cash flow received later, and a rate for one period isn't automatically a rate for another period. So remember the discipline, identify the cash flows, identify the timing, choose the appropriate required return, and discount consistently. Let's now discuss yield measures and bond price categories. Yield to maturity is the discount rate that makes the present value of a bond's promised cash flows consistent with its current market price. It is a very useful summary measure, but it must be interpreted carefully. Yield to maturity assumes the bond is held to maturity. It is based on promised payments, so default risk can make the realized return different from the quoted yield. It also summarizes multiple cash flows with one rate, and when interpreted as a realized compound return, it assumes coupon payments can be reinvested at that yield. Current yield is different. It measures annual coupon income relative to the current bond price. It is easy to understand and useful as an income measure, but it is incomplete. It ignores capital gains or losses as the bond price moves toward par value. It also ignores reinvestment. Now consider the relationship among coupon rate, required return, and price. A par bond trades at par value. For a plain vanilla fixed-rate bond, this generally occurs when the coupon rate equals the required return, using consistent conventions. A discount bond trades below par value. This usually occurs when the coupon rate is below the required return. A premium bond trades above par value. This usually occurs when the coupon rate is above the required return. The key intuition is simple. The coupon rate is fixed by contract for a fixed-rate bond, but the required return changes with market conditions and issuer risk. When required returns rise, existing bond prices fall. When required returns fall, existing bond prices rise. Let's bring everything together. A bond's required return is the return investors demand for giving up money today and bearing the risks of the bond. For a default-free nominal bond, this return is closely connected to time value, expected inflation, and maturity. For riskier bonds, investors require additional compensation. That compensation may reflect default risk, liquidity risk, maturity and interest rate risk, tax effects, and embedded options such as callability, puttability, or convertibility. For issuers, a higher required return means a higher cost of debt capital. For investors, a higher yield may mean more compensation, but it may also mean greater risk. Interest rates affect bond values because they affect discount rates. When market rates rise after a fixed-rate bond is issued, the old coupon becomes less attractive and the bond price falls. When market rates fall, the old coupon becomes more attractive and the bond price rises. Bond markets also use quotation conventions. The clean price excludes accrued interest. The dirty price includes accrued interest and is closer to the actual amount paid at settlement apart from transaction costs. Accrued interest matters because coupon interest accumulates between payment dates. Before we finish, remember the common mistakes: confusing coupon rate with yield, treating current yield as total return, ignoring principal repayment, mixing timing conventions, ignoring credit risk, ignoring embedded options, and comparing yields without checking tax or currency differences. A disciplined bond valuation process begins with cash flows, timing, required return, and risk interpretation. Thank you for joining me today. I hope this lecture helped you understand bond markets and bond valuation more clearly.